Hello everyone. For quite some time, bond markets looked dull. But since some week, we can say bye-bye boredom and hello attention. But the attention raises more concerns than enthusiasm because inflation and central bank responses have pushed bond indices back into the attention-grabbing red color. The performance of the global Bloomberg bond index that combines both government and corporate debts has fallen by 11% from its peak in January 2021. And this is more than the 10.8% drop seen during the 2008 financial crisis. In terms of market values, this is equivalent to a loss of around $2.6 trillion compared to the $2 trillion loss in 2008. The setback is brutal for investors as it contrasts with years of successive gains fueled by accommodative central banks. The current inflationary surge is also creating uncertainty about the ability of the global economy to cope with rising yields over an extended period. Such an environment does not favor exposure to either corporate or sovereign debt. And even though sovereign debt is considered safer from a credit quality perspective, it is far from immune to duration risk. The US yield curve shows very well that the status of risk-free asset is only a partial guarantee of protection. Year to date to March 23, the upward pressure on the curve has resulted in losses of 2.1% on 2-year maturities, 6.9% on 10-year maturities, and 13.4% on 30-year maturity. The revival of the bond market is, of course, the work of central banks. After raising interest rates by 25 basis points last week, the Fed said this week that it was ready to tighten them by 50 basis points at the next meeting if necessary. While it is highly unlikely that an exact path for interest rates and yields between now and the end of 2022 can be mapped out, one thing is certain: the headwinds will remain in place and bond investors will have to stay on alert. Soaring commodity prices further complicate the outlook for a bond market already weakened by the fastest pace of inflation in decades. To spice things up, the market is not ruling out the risk of stagflation in case of an overly aggressive monetary policy normalization, a scenario that would be unfavorable for corporate bonds as an economic slowdown would increase credit risk. In short, there is no shortage of excitement, and the bond asset class provides its share of emotions. The current slump could be a reminder of the Fed's tightening cycle in 2018. The global aggregate index only lost 1.2% that year, so all hope is not lost. But as we often say in markets, things can get worse before they get better. Thank you.